Welcome to Frank Wealth Insights, a financial and investment podcast from Return on Life Wealth Partners. They look at your money. We look at your life at returnonlifewealth.com.
Welcome back to Frank Wealth Insights. I hope everyone is well. I am your host, Frank Fantozzi, President and founder of Return on Life Wealth Partners. Our goal is always to provide thoughtful discussions on financial topics that empower you to make informed and confident decisions about your wealth. Today, we're tackling one of the most critical and complex topics for executives and business owners: executive compensation and key person retention tools, also known as golden handcuffs. If you're an executive, business owner, or financial decision maker, understanding these tools are crucial for attracting, retaining, and rewarding key employees while also maximizing financial opportunities. We're going to break down stock options, restricted stock units, deferred compensation, phantom stock, and split dollar life insurance. There are variations to all of these, but this is all we have time to do today. We're going to talk about tax planning, pros and cons of each of these, and how they can impact your long-term wealth planning. The hope is by the end of this episode, you'll have a roadmap to make more informed decisions with your executive compensation and key employee retention program. The compliance department reminded me before we dive in, these topics are very complex, so we are taking a very high-level view and thus should not be considered specific tax advice to any one individual's circumstances. You will need to discuss your specific situation with your CPA, your attorney, to ensure you are making the best decision for your needs and that the strategy selected meets legal and IRS requirements. So without further ado, let's dive in. The first area we're going to talk about that impacts executives normally at publicly trading companies, given that their stock is valued every day. These are called stock options. They can be very effective for companies and employees to incentivize everyone to grow the company's stock price. Otherwise, there's no value to these type of executive benefits. So this really does align employees with company value. The first stock options we'll discuss are ISOs and NISOs. You're going to see a lot of these little abbreviations, but basically they're incentive stock options and non-qualified stock options. Stock options give executives the right to purchase company stock at a set price, or what they call the exercise price, within usually a specific time frame. So we're going to start with ISOs. So let's discuss how do they work. So incentive stock options are tax advantaged and are only available to employees. The company grants this right to buy shares at a fixed price. If those stock options are held for at least 1 year post-exercise, normally the stock is in the black, meaning the stock has increased in price. And then 2 years from the grant, the profit is taxed as long-term capital gains, which normally is a lower tax rate than the ordinary income tax bracket of the executive. So let's talk about the tax impact of incentive stock options. So there are no ordinary income tax events at the exercise of ISOs, but they can trigger an alternative minimum tax called AMT. This is kind of like the backup tax where it is perceived that high net worth or high net earning individuals are not paying their fair share, and so they basically reduce some of the benefits or deductibilities that you can take on an ordinary income tax return. So really it's kind of like two tax returns. So basically what happens is if the spread between the exercise price and the fair market value is large, this will add to your AMT income. If held for the required period, gains are taxed at a lower capital gains rate. So if you hold the option and exercise it and wait 2 years from the grant date, you will get long-term capital gain treatment. If sold too soon, before the holding period expires, gains are taxed as ordinary income tax instead of capital gains. So let's go through an example, because I always find that makes it a little easier. So we have an executive, Sarah, who receives ISOs at $20 exercise price. 5 years later, the shares are worth $100, so there's been an increase in value of $80. She exercises them because they're in the black, but waits another year before selling. That $80 gain per share is taxed at long-term capital gains rate, 15 to 20%, instead of the ordinary income, assuming she's at the highest tax bracket of 37%. A little key AMT trap. If Sarah exercises her options but doesn't sell in the same year, she owes AMT tax on the paper gain, even if she hasn't sold the shares. So again, careful planning is very, very important when managing your stock options plan. Next, we're going to turn to non-qualified stock options, or NISOs, NSOS. How do they work? Non-qualified stock options are not tax advantaged, so they can be granted to employees, directors, and or contractors. That's an important note. When exercised, the difference between the stock's market value and exercise price is taxed as ordinary income, not capital gains. Companies often withhold taxes at exercise, or if there are this privilege called a cashless exercise, meaning some of the shares can be sold to pay the tax. This is another option that could be considered when these NISOs are exercised. So let's again go over the tax impact. At exercise, they are taxed as ordinary income, basically the same as an executive salary. At sale, gains above the market value, market increase, at the exercise point are subject to capital gain tax. So let's go through another example, because again, putting numbers to the rules always helps, I think, solidify how this should work. John receives NISOs at a $20 exercise price. 5 years later, the stock is worth $100. When he exercises, the $80 spread is fully taxed at ordinary income, likely again, we're assuming at 37%, plus payroll taxes. If he holds the stock and sells it later at $120, the additional $20 gain is taxed at capital gains rate, which is 15 to 20%. So again, here you have a bifurcated tax. The actual spread between the exercise price and fair market value, that $80 is taxed at ordinary income, and anything above is taxed at capital gain rate, any appreciation from the time he or she exercises the stock. The downside is, since taxes are owed immediately upon exercise, NISOs can create cash flow issues if the stock isn't sold right away. But again, a lot of plans offer what they call a cashless exercise. So they basically sell your shares or a portion of your shares automatically to cover the tax burden that's owed to the IRS. So again, a cashless exercise can be very helpful for executives regarding cash flow. So now we're going to go into another type of option planning that you see at large publicly traded companies called RSUs, or restricted stock units. So let's discuss how they work. RSUs are company shares given to employees without an upfront cost, but instead they have a vesting schedule to help tie the executive to the company. So let's use an example for 4 years with an annual vesting over that period of time. Once they're vested, RSUs are taxed as ordinary income based on the market value at the end of the vesting schedule. So let's again look at the tax impact. They are taxed as ordinary income upon vesting, not exercise. There are no AMT or alternative minimum tax risk, but there are no tax deferral options. So again, we're going to go back to Lisa, who receives 10,000 restricted stock units when the stock is worth $50 per share. After 4 years, she fully vests and the stock is now worth $100. She owes ordinary income tax on $1 million, which is 10,000 units times the $100 share price, even if she doesn't sell the shares. So again, the challenge here for Lisa is that she must cover the tax bill even if she holds the stock. Again, many executives sell the RSUs to cover the taxes, usually in what they call, again, a cashless exercise. Again, these following executive compensation plans that we talked about, the restricted stock units, NISOs or non-qualified stock options, and ISOs, incentive stock options, are very common in publicly traded companies, as well as deferred compensation, which we'll talk about next. However, other plans like phantom stock and split dollar life insurance plan are more commonly seen in closely held companies, which we'll discuss as well. So again, trying to break this out in little bite-sized units so you can see their applicability. But again, these are valuable tools in regards to rewarding executives and retaining executives based on how they're structured. So the next plan we're going to talk about, and this bridges a common plan between publicly traded companies and closely held companies is deferred compensation plans. And as I speak, you're going to find like, wow, this sounds very similar to a 401k plan. And in fact, they're often called mirror 401k plans with a few important differences which we'll discuss. But again, this is another effective way to defer compensation that's really not needed while you're in a higher tax bracket, and then to take it out at a later point when you're in a lower tax bracket. So it creates that same tax arbitrage that you see with 401k plans. So basically how it works is it allows an executive and or business owner to defer a portion of their salary, bonuses, and RSU proceeds to a later date, most likely in retirement when you're in a lower tax bracket, hopefully. Your funds do grow tax deferred until withdrawn. And again, it mirrors a lot of the 401k plans. And in fact, a lot of these plans will have similar, if not identical, investment options to the 401k plan. The tax impact is very similar to a 401k plan. No tax is owed on the deferred amounts until withdrawn. And withdrawals are taxed at ordinary income, but hopefully they occur in your lower tax years. Now, a key point and difference is you usually have to make a one-time election that you can't change as you can with your 401k plan. So for example, if I decide to defer at a certain percentage on my 401k plan, I can later change that. Typically what you have with deferred compensation is you usually make an election in November, December of the previous year that I am going to defer, let's say, 20% of my salary and any bonuses I receive in the following year. Once I make that election, I can't go back. I can't change it. If things change for me personally, that's part of the risk. But again, it's one of the differences I wanted to point out that's different than a 401k plan. So let's look at an example. Mark decides to defer $200,000 of his bonus for 5 years. And instead of being taxed at 37%, which is the current bracket he's in, when he retires, he's planning on being in a 24% bracket. Thus, he wins in the tax arbitrage, as I mentioned earlier. But here's another important difference. Your 401k plan is an ERISA plan, and there is guarantees and safety measures to protect your balance in the 401k plan because it is segregated from the assets of the company. So a risk in deferred compensation is if the company goes bankrupt, the deferred comp is at risk since it's not protected account like the 401k plan. It is technically a corporate asset that's earmarked to pay you in the future, because what happens is when you defer your compensation, you are not paying any FICA and FUTA tax as well. Again, another important difference. If you notice on your W-2, you will defer your 401k plan amount and your taxable wages will be lower. However, you still pay tax on your full FICA and FUTA. In deferred compensation plans, you do not pay any FICA or FUTA tax. So in essence, you've never received the compensation. That's why it's considered deferred compensation, and it's segregated from you having any type of ownership of that money. Hence, it is a corporate asset. However, often these deferred compensation plans are attached to a rabbi trust, which does protect from bad ownership for invading the money, or if the company is sold or new owners come in. That offers that level of protection. What it doesn't protect, again, and I can't emphasize this enough, is that the company, if it goes bankrupt, your deferred compensation plan is at risk. So thoughts need to be put into how much you want to defer and put at risk. Now, this is a little bit advanced, and I can't spend a lot of time on it, but in these deferred compensation events, they will put triggers in the agreement so that if the debt to equity ratio or income falls to certain thresholds before the company goes bankrupt, those assets can come out. But understand, if you have a lot of money built up in deferred compensation, it's all going to be taxed in the year in that triggering event. However, if I had to take a choice of losing my money to creditors or paying the tax and giving it up to Sam, I will gladly pay the tax. So one of the things in evaluating a deferred compensation plan, are there favorable triggering events so that your money is less at risk? There's no way to make it 100% riskless, but these are some of the decisions you have to make if you want to participate in a deferred compensation plan. So before we move on to Fanta stock arrangements and split dollar life insurance plans, I just wanted to recap a couple additional planning strategies for executive compensation regarding ISOs and alternative minimum tax mitigation. So one of the things you can do as an executive is exercise small amounts yearly to stay below AMT thresholds. Use AMT credits in the future to recover overpaid taxes because you have these carryover credits. You can align some of your planning with charitable giving strategies. So for example, you can donate appreciated stock to a donor advised fund to avoid capital gains taxes. You can use charitable remainder trusts, or called CRTs, for executives expecting a liquidity event. So for example, let's go back to Emily. She donates $500,000 in company stock to a donor advised fund, or a DAF, before selling. She gets a full tax deduction and charitable tax deduction and avoids capital gain tax. So those are some planning techniques. Again, we talked about earlier, these are complex mechanisms, so you need to work with your CPA or attorney and or financial advisor to make sure you understand all the ramifications, because one of your biggest drags on creating wealth is paying Uncle Sam. Uncle Sam's always there and willing to take money out of your pockets. Other things to consider are liquidity events and large windfalls, so how to prepare for that. So you can sell stock gradually using, and again, this is a publicly traded item. So if you sell stock gradually using what they call a 10b5-1 plan, it's called a pre-scheduled sale to avoid insider trading rules. Again, this is specific to publicly traded companies because, as you can imagine, there's insider trading, and I'm sure you've read over time in history abuses where executives get out and sell all their stock before the company price falls, and so they don't take a big hit. So now executives have to report all their sales as public information, and then this becomes something that people can watch. Hedge stock positions as well, what they call collars and prepaid forward contracts. Again, these are more advanced techniques that your financial advisor can help you. But for example, Tom's company has an IPO and his RSUs vest at 2 million restricted stock units. He sells 50% immediately to cover taxes, and then he reinvests the rest in a diversified portfolio so that all his stock isn't tied to one company. So again, one of the things we talk about, with stock options is that for executives and other employees, it's a great way to build wealth. If you're fortunate enough to, work at a company like, Amazon or Meta, people are made instant millionaires. The risk with that is that you have a concentrated stock position, and so keeping too much employer stock can be dangerous. Think of General Electric, think of Enron, which is worse, or Lehman Brothers. So, the golden pony could be great on the accumulation side, but you always have to think about, do you want to keep everything tied to one company? And it is a common strategy, again, for executives and other employees of the company to get into a diversification strategy. So you've made all that wealth. Now your goal is to figure out how to protect all that wealth. Lastly, for the stock options section, again, aligning compensation with wealth goals and diversified strategies. A couple other tools that we use is exchange funds. So you can swap an employer stock for what they call a diversified fund without triggering taxes. So basically, you go from one stock to a basket of diversified stocks of the S&P 500. It's not all the S&P 500. It's whatever the exchange fund decides it wants to hold. You can also use tax-efficient trusts like GRATs and SLATs. SLAT is a spousal lifetime access trust, and a GRAT is a grantor retained annuity trust to transfer wealth while minimizing taxes. Again, these are advanced techniques. I'm just trying to make you aware of them so that when you have a conversation with your CPA, attorney, or financial advisor, this is not foreign language, because it can be very foreign to people that don't work in it in an everyday basis. So an example here again, to close out this section. Brian has $10 million in an employer stock. He contributes $2 million to a GRAT to reduce his taxable estate and shifting growth to his heirs tax-free. So, one of the things we've been focusing on most of the time here is your income taxes. But for people that have accumulated enough significant wealth, you could potentially have an estate tax problem. And so some of these tools, like a GRAT, will help reduce your taxable estate and shift more of your assets to your heirs. And that way you pay lower taxes, because on an estate tax, once you hit over your lifetime credit, which right now is approximately $27 million for a married filing jointly couple, anything over that, you're going to pay 40 cents on the dollar. So that becomes pretty extensive and pretty expensive for someone who has accumulated wealth and doesn't want to turn around and pay 40 cents on the dollar to Uncle Sam. So now the shift is really going towards tools that are used or found in many closely held businesses. And we're going to talk about phantom stock arrangements and split dollar life insurance, including advanced strategies, variations in their structure, additional tax considerations, and some real-world applications that could benefit closely held business owners. So we're first going to start out with phantom stock arrangements and closely held businesses. So how does phantom stock work? Phantom stock is a synthetic equity program, which is a fancy word for saying it's fake equity. It is designed to provide executives with an incentivized alignment of their initiatives with that of the company growth without actual stock ownership. The other benefit is that you're not providing, cash right away, so it becomes a very good cash planning strategy for the business. And really, conceptually, you can see the benefit here. I'm giving basically fake stock that's going to have a value, and if they help the executives help me grow the company, I'm going to reward that growth, or part of that value of that growth from this point forward in this phantom stock. The other thing is it makes it very simple, because this is not an ERISA plan. There's no government regulations to follow, so you can be very creative with its structure. So that's very, very helpful in these type of plans. The other is you don't have minority business owners. Now, in smaller businesses, I tell my clients who are the executives is, listen, you're a minority owner in a business. You really don't have a lot of leverage or strength. You really just are participating in the growth of the company. So if really all you want is the growth of the company because you're contributing, phantom stock gets you there. Now, if it's really important to have ownership and have a say, that's a different conversation, which we're not going to get into today. But understand that you're still a minority owner. Now, as the majority owner, you do have a fiduciary duty to the minority owner. So it's not like you can do anything you want for any reason. Again, there's a fiduciary duty, and again, we can't get into all of that today. But from an all practical standpoint, it's show me the money. Most people are like, show me the money. So if phantom stock really accomplishes the rewarding of your efforts to increase the company value, then there's really great alignment in using this type of plan. So basically what happens then is the employer assigns a number of phantom stock shares to a key employee which mirror the real value of the company shares at the point of assignment. At some future date, whether it's a set vesting schedule, retirement, sale, for example, an IPO acquisition, or to use the money to buy in, if you're part of a management group that wants to buy the company from the family down the future, that money can be then credited towards that future purchase price. So that's a very common and very effective way to allow the key stakeholders to buy the company at some point in a succession plan or some other performance trigger. But you can see how effective the planning is in golden handcuffing the executive. Now, as an executive, you're saying, well, wait a minute, I got to wait 15, 20 years to get, value. Yes, if that's what you agree to. But usually the reward is pretty significant. And, if I'm the owner, I'm sitting there going, well, wait a minute, I'm going to give you a lot of value here in participating in the growth of the company above and beyond my compensation strategy that I'm paying you right now. I'm paying you a very competitive salary plus other benefits. So I want to make sure that you're going to stick around versus, you learn all this knowledge from me and the company, and then you take it to another competitor or start to compete against me. I want to make sure I prevent that. And so having a longer vesting schedule, or the use can be either for retirement only, so you would get to a certain retirement age, and or use it to buy the company. Yes, I know that might sound extreme, but again, look at the benefit that the business owner is really providing. Because usually it's pretty significant if the ownership really helps working with you grow the company significantly. This could be a huge windfall. So really there's two basic types of phantom stock. There's the full value phantom stock, and then there's the appreciation only phantom stock. So in full value phantom stock, basically the employee receives the full value of the phantom stock upon vesting. So I give you phantom stock today, and I'll go through this example here. Sarah, the CFO of a closely held firm, receives 5,000 phantom shares at a starting price of $50 per share. After 5 years, the shares are worth $100. If she has fully valued phantom stock, she receives $500,000, which is the full value of that stock. In the appreciation type of phantom stock, basically it's like a stock appreciation right, so it's appreciation only. So if she has a SAR for a phantom stock, she's only going to receive the appreciation. So using that same example, she was given that stock at $50 per share, and now it's $100. Instead of receiving $500,000, she only receives $250,000, which is the appreciation from the point she received the stock, $50, to what its current value is today of $100. What's nice about phantom stock from an employer and even employee standpoint is you could be very, again, creative in how you structure these. From the time of vesting or performance triggers, they can include, again, time-based vesting. So employee receives benefits only if they stay until the employee reaches a certain vesting schedule. Call it cliff vesting. So after 5 or 10 years, they receive 100% of the value. You can make performance-based vesting. So employees must hit revenue, or what they call EBITDA, earnings before interest, dividends, depreciation, or amortization, or profit goals to receive payout. So if you're not hitting $1 million in EBITDA, you get no vesting. Or it could be a liquidity-based vesting. Payments occur only if the business is sold, for example, to the key stakeholders, which would be me, the executive, or an IPO. I sell to a third party, and I want to ensure that you're there. So a family-owned manufacturing company wants to retain their COO. They structure the phantom stock to vest upon sale of the company, ensuring that he or she stays until this liquidity event. So you can see the creativity of this type of planning, and it's very, very effective because I hear all these concerns. Well, my employee wants to have ownership, and we really try to dig into it. Do they understand what ownership means? Because having ownership is a different standard than not having ownership. Or is the real question, the key employee, are they saying, listen, because of my talent, I'm helping this company grow, so I want to see a piece of the action. So that tells me it's really more about the Benjamins, or the dollars, than it is actually ownership. So you really need to peel back the onion that this type of planning is very well thought out and aligns with what the company is looking to do. Other key benefits or tax implications for phantom stock. For employees, there's no tax impact at the grant. They are taxed as ordinary income when paid out, so it is subject to payroll taxes, FICA, Medicare, state and local taxes. And unlike actual stock, there's no capital gain treatment, which is a little bit of a downside when you use phantom stock. For employers, payouts are fully deductible as compensation expense, and there's no stock dilution or ownership change, which again greatly simplifies things. So I go back to simplicity and aligning interests as a key component of looking at phantom stock as a possible fit. Tax strategy, employers may want to structure payouts over multiple years to avoid large tax spikes for the employees. So you could create a grading vesting schedule. But again, that's less beneficial than if you're looking at as a triggering event for ownership or a liquidity event like an IPO. Pitfalls: if it's not properly structured, phantom stock might be reclassified as deferred compensation under Section 409A, which again can trigger certain tax penalties. So again, getting sound legal advice along with tax advice is going to be very critical in setting this up. But again, phantom stock's a great way to align key employees with growing the company. So let's transition to our last key type of planning that, again, you often see more in closely held businesses, private companies, than you do public. Again, they can be used on both, but I tend to see stock option planning more significantly in publicly traded companies, along with deferred compensation, and seeing deferred compensation, phantom stock, and split dollar life insurance programs in your privately held, closely held businesses. So what is split dollar life insurance? And what does this all mean? Because you're like, wait a minute, what's a split dollar life plan? And it can get kind of confusing. Again, all these plans we talked about today have a level of sophistication and complexity, which allows it to create some unique outcomes. So I think they kind of go hand in hand, and hence, again, working with your advisory team is important. So split dollar life insurance is a powerful strategy for key person retention because it does provide long-term value to the executives. It can help with estate planning because it allows us to transfer wealth efficiently through using life insurance proceeds. And it can be a deferred compensation alternative because it does offer a tax-efficient way to supplement retirement benefits, especially as the plan accrues. We talked about in deferred compensation that the company doesn't get a tax deduction for deferring the comp and the employee doesn't recognize income. But while that money sits in the deferred compensation plan in a traditional plan that we talked about, the mirror 401k, any earnings is taxed to the company, so it's less tax efficient. One of the benefits of considering deferred compensation, especially if you're doing it only for a few people, is to use life insurance because the cash value buildup in a life insurance plan is not taxed. So again, often it's used because cash value buildup is not taxable to the company. The life insurance then can be an additional benefit to the executive or the business owner because now you have two benefits. You have money that's going to be paid out in the form of some type of retirement benefit, and you have life insurance, which also might meet the need for the executive and or the company if the company is looking to recover the benefits that it's paying out. And you'll see that in the two examples that I'm going to discuss here. So the two common types of split dollar life insurance arrangements is one called the collateral assignment, or what they call the loan regime, and then the other is the endorsement split dollar, or what they call the economic benefit regime. So let's discuss the collateral assignment first. In this situation, again, collateral assignment, so you're assigning the benefit. So the collateral owns the policy, and the company loans the premium payments to the executive by paying for the plan. The loan is repaid later, either from some portion of the cash value, because you can decide how to split the cash value in the future, or they can recover it down the road. The company can recover it down the road via the death benefit. The executive then can access the tax-free withdrawals from the policy during retirement. So again, let's discuss a simple example. I am a law firm. I wanted to provide an additional compensation plan to my managing partner, David. The law firm funds a $2 million whole life policy on David's life. And as again, a caveat, any cash value based policy can be used. So you can use, for example, a variable universal life contract, which tends to be tied to the performance of the underlying investments, which replicate, mutual funds in the open market. So that's another common. So basically, any cash value policy can be used for this. I'm just using whole life in this example. The firm loans $40,000 a year in premiums, which grows inside of the policy tax-free. At retirement, David withdraws $500,000 tax-free, and the firm recoups its loan from the death benefit on the insurance on David's life. So there's no taxable income to the executive during the loan period. At death, the company receives loan payment tax-free, and the heirs receive the remainder of the death benefit, David's heirs, tax-free. The pitfall is if the loan isn't structured correctly, the IRS might treat this as additional compensation, triggering really immediate taxation, which again goes back to don't be penny wise and pound foolish. Make sure that things are set up correctly to avoid the traps. I mean, you're getting, as an executive in a company, you have an important benefit. Cutting corners at this point isn't advisable. On the endorsement split dollar, again, we call it the economic benefit regime. In this situation, the big difference here is the company owns the policy and provides a portion of the death benefit to the executive's family. The executive pays tax only on the economic benefit of the insurance, which is basically the term insurance cost, which is far lower than paying the full premiums, which often and always are used to drive up the cash value buildup. So basically, you're paying tax on the value of the term insurance, which shows up on your W-2. So for example, a private equity firm wants to reward its CFO, Jennifer. The firm pays $50,000 a year into the policy on her life. Jennifer and her family is entitled to the $1 million of death benefit. Jennifer pays tax only on the cost of the insurance coverage. And for this example, to keep it very simple, the value of that insurance amount this year is $2,000. Now, the technical term is a PS58 cost. There's a table that the IRS publishes. So basically, next year, the term cost will go up slightly because Jennifer's a year older. But again, it's substantially less than the value of the full $50,000. The company receives premiums back from the final death benefit, and then the executive's family receives the portion of death benefit tax-free. The company then also can be used to pay out the cash value as part of a deferred compensation arrangement. So the client, if the client is the executive, receives not only a retirement benefit, but a portion of death benefit as well. So you can see the significant benefit. And because it's, again, not an ERISA plan, which means you have to cover everybody like in a 401k plan, I can specifically choose to carve out key people. So that's really what's really critical here. So the pros and cons of a split dollar life insurance arrangement, the pros are this. It preserves ownership structure. There's no stock dilution like equity-based plans. They're tax efficient because they allow for deferred growth and tax-free death benefits. You can do customized vesting schedules, which can be tied to retirement, business sales, or other conditions. So you can see some of the similarities to, again, the phantom stock here. The only risk, candidly, is underwriting for health reasons. This can create challenges if the executive and or owner, depending on who you're using this plan for, is what they call rated. In other words, they have sugar diabetes. Instead of paying the standard cost, call it 100% of the standard rating, you might pay 150 or 200% the standard cost. So all of a sudden now the cost to provide the benefit, the insurance cost, really eats away at the cash value buildup, which could minimize the value of this plan. So what we normally recommend is that they go through a pre-screening to see if there's certain medication or health events that have happened before we get too far down the road, like spending money on an attorney to draft up all these agreements, and then only to find out that, oh my God, the guy is uninsurable, or the gal is, has a 250% rating, and it doesn't make sense anymore. So what you should be doing is doing a health check. You're not applying formally to the insurance company. You're really talking to the underwriters and saying, hey, if Miss Jennifer applies for the plan and she's taking these medications and had these small medical issues in her life, how would you look at it? Now, they're not going to guarantee it, because until they actually get the medical records and there's a formal application, then they're going to apply and make what they call an official offer, which you can accept or walk away from. But if you're honest on the intake form here and present all the same facts, they are very good to work with. They don't want to take on an underwriting project which costs time and money and then have you walk away from it. So they usually give you a very clear answer and say, well, based on underwriting, she'll be in the 150% to 200% rating, or, that's not an issue. We're just going to issue her at standard. She won't get preferred, but she'll get standard. Or they can come back and say, wow, she's uninsurable. So that's an important step in doing any type of split dollar, is if conceptually everybody's on page and says, yeah, this is a good fit, before you spend any other money, go get a preliminary unofficial offer from the underwriters of the insurance company you want to use, and then see if the value still comes back the way you would like. Again, just like with phantom stock and all these plans, there's complex legal and tax structuring. You have employer funding obligations, so companies must be willing to commit to the funds. Right now everyone's happy, and companies saying, "How I'm willing to put $50,000 into a split dollar plan for my employee," but then 3 years later, the big client leaves, and now cash is tight. So there is a requirement, and again, especially with split dollar plans, but even phantom stock, if things are not structured correctly, the IRS may recharacterize these loans as taxable income in using split dollar cases here. So again, best use cases for closely held businesses: phantom stock for retaining executives in private companies without giving equity. SARS, another version of the phantom stock. It's lower cash flow risk by only paying out stock appreciation versus the full value phantom stock we talked about. Collateral split dollar is very effective for providing retirement benefits without the upfront employee costs. And endorsement split dollar, offering tax-free death benefits to key employees with minimal tax impact. But again, with collateral and endorsement, because you can, what they call, divide the baby up the way you want, you can provide retirement benefits in both, and you can also provide insurance value in both. So final thoughts and an action plan. Executive compensation, especially in closely held businesses, requires strategic structuring. Phantom stock and split dollar life insurance are very powerful tools, but they need to be tailored for tax efficiency and what we call risk mitigation. Can't emphasize enough in any of these plans, you need to work with tax and legal advisors to properly structure phantom stock and split dollar agreements, ensure vesting schedules align with business goals, for example, sale and retirement. At the end of the day, you have two parties that are agreeing on a specific outcome, so you want the structure to reflect that specific outcome. And then keep in mind, try to find ways to create tax deferral and estate planning strategies to maximize wealth retention. So if you're an executive or business owner looking for customized executive compensation plans and you do have further questions, please give me a call. So again, thank you everybody for joining me today on this episode of Frank Wealth Insights. We covered a lot. I warned everyone in the beginning that this was going to be a little more complex because of the financial benefits that could be accrued not only to the executive or business owner, but to the company itself. There are a lot of hurdles and steps that need to be considered and carefully planned. So I appreciate you staying with me through this whole episode and found a lot of value. Again, if there are any questions about navigating the complexity of executive compensation and key employee retention packages, please give me or anyone on our Return on Life Wealth Partners team a call. Our number is 877-514-9991, or you can visit us at returnonlifewealth.com, and there's a place where you can send your question or information about this topic, and we'll give us about 48 hours to respond, as we're usually on the phone and dealing with emails of our current clients. And please don't forget to like and subscribe to Frank Wealth Insights if you feel this is a great podcast format for you and you want really actionable, clear content that can either help you or someone you know. Please pass this along to others if you feel others would benefit. And really, until next time, here's to your health, happiness, and a life well lived. Thank you again, and have a great start to 2025.
This has been Frank Wealth Insights, the financial and investment podcast from Return on Life Wealth Partners. Your life, your money, your way. Experience financial planning the way it should be, not the way they want it. See how at returnonlifewealth.com. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax situation with a qualified tax advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. This communication expresses the views and opinions of the participants as of the date it was recorded or indicated, and such views are subject to change without notice. This podcast is being made available for educational purposes only and should not be confused for any other purpose. The information contained herein does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities or related financial instruments in any jurisdiction. This podcast may discuss forward-looking statements that are based on then current beliefs of the participants. Investment advice offered through Planned Financial Services, a registered investment advisor.